Remember when stocks only went down? We do. You're in the right place, folks, because this is where the money is. Welcome to the show, folks. I am David Hanson, joined by Tyler Riggs.
Great to be here. Thanks
Tyler,
for having me.
you are part of our banking financial services coverage down on Fool.com.
Absolutely.
Making your first appearance on Where the Money Is.
Hope it all goes well. We'll see how it goes. Yeah.
Does it feel good?
It feels good. I'm
All
excited.
right. We're going back in time a little bit. Yesterday we had Patrick Morris on. We did not talk about the bull market turning 5. Everyone else was talking about it. We decided to focus on the business. Business as normal, but we're bringing it back today. We're going back in time. We're looking at 3 headlines from March of 2009 just to see what can we learn, what were we wrong about, what were other people wrong about. We like to say that.
More importantly, what other people
Exactly.
were wrong about.
We weren't wrong about anything. So going to the first headline, this is from Wall Street Journal on March 3rd, 2009. It says stocks hit 1997 level, signaling long slump. Now, we were talking about this before, and it's really easy to look back at this and saying, well, that's the bottom. Everyone knew that was the bottom, but 2020, hindsight is always 2020,
Yeah,
right?
Exactly. Us looking back at these articles today is a little unfair to the actual writers because we know—
A lot unfair.
Really unfair, but whatever. But yeah, they didn't know at that point that was the bottom, March 2009. We do, but I think from reading these articles, from going back and seeing what people were talking about, I think there's a lot of good lessons we can learn there, and a lot of things we can prepare ourselves for in the future. Because this is not the last dip that's going to happen. This is not the last moment of crisis that the market's going to be so world-ending.
It wasn't the first, and it'll be definitely not the last. And one of the things that stood out to me in that article was, and I'll read a quote from it, was, "Gone are the days where the mantra among investors was, buy the dips," something we hear a lot today, on the belief that when stock prices fall, they're likely to rebound. Instead, the opposite sentiment has taken hold. So basically, everyone's saying, well, we'll buy the dips during a bull market. That's what you're supposed to do. But then when you have something like this where stocks are down 40%, 30%, in some cases 80% individual stocks, then it's a lot harder to say, yeah, I'm going to buy the dip. And that stood out to me because Seth Klarman, the famous hedge fund manager, amazing track record over decades here, came out with a letter to his investors, I think it was yesterday or the day before, saying something pretty similar. And here's what he said in his letter. He says, "When the market's reversed, everything investors thought they knew will be turned upside down and inside out. Buy the dips will be replaced with, what was I thinking? Anyone who is poorly positioned and ill-prepared will find there's a long way to fall. Few, if any, will escape unscathed." So like you said, history will repeat itself. Maybe Seth Klarman's right about the timing here. Maybe we're getting closer to that, but good to read these articles and be reminded that this stuff will happen.
And I think that the other thing too is that these articles always say it's different this time, or it's not. This has changed the paradigm of investing, and it's just not true. I mean, it's just, we can always say, this method doesn't work, or like I said, buying the dip doesn't make any more sense anymore. It's not entirely true. It's just something where people look for answers in times of extreme uncertainty, and this is what the articles are produced. This is what we're talking about.
Exactly. And some of the advice that was given, and we kind of have a second article on there from Jason Zweig of the Wall Street Journal, who's a great writer and has given tons of great advice. And some of the advice looking back doesn't seem that great, kind of saying, well, you can gradually sell your holdings and move them into bonds. But like we keep saying, it's easy to say that now, knowing that the stocks went on a great 5-year run.
I think the one thing in Jason's article that a lot of his advice is to investors that were burned by the stock market and seemingly don't want to touch it ever again in their investing, careers.
Trying to give them like an easier way out.
Exactly. The problem is that those people are the same ones that are going to be, once they see the stock market going up and up and up for 5 years straight, they're going to be the ones that are jumping back in potentially at precisely the wrong time.
Right.
And I think that's the thing there, is that you've got to think long term with this stuff, and everybody's got sort of a selective memory. When they lose money, it really stings, it really hurts. But over the years, when you start forgetting about that, when you can basically invest in anything and it's going to go up in the next 5 years, people start to lose those lessons that they really learned from 5 years ago. And I think that's the important thing there, is that the cycle repeats itself, and you need to be cognizant of that.
All right, moving on to the second headline, staying back in time, staying in 2009. This is from Market Watch. Winters of discontent, and then the subtitle there is 3 to 6 years before investors recoup portfolio losses, advisors predict. Now, you pointed this out to me, 3 to 6 years before we recoup losses, turned out to be a pretty darn good prediction here from advisors, whoever they surveyed here.
When we were looking for articles back in 2009, I thought it'd be just easy to find all these sort of horrible predictions or just way off base articles. But this one was actually surprisingly interesting because it took about 4 years for the S&P to recover from its, or to get back to its pre-crisis high. So I think that was sort of interesting right there to see that advisors were pretty spot on. I mean, 3 to 6 years, we could say it's kind of a large time frame, but that's still fairly accurate too.
Right, and Morgan Housel, one of our writers for Fool.com, recently wrote an article saying, back in 2009, some traders and short-term investors knew that a rally was coming, but they just couldn't withstand another down month because their compensation, their livelihood is tied to performance, and if they go into stocks fall another 10%, that's not going to look very good on them.
Absolutely.
So what the individual investor has to their advantage is this isn't your salaried job. You're not based on your stock market performance.
You're not giving updates to any clients or anything
exactly.
like that.
So you have the ability to stay in there and say, well, I can withstand another month. Yes, my holdings may go down in value, but this doesn't risk my job here. I'm not going to lose my livelihood and everything I have because I hold stocks for another month. So that's a huge advantage that investors can have there.
And I think one more thing from that article too that we noticed is that they looked at predictions for the next year. What are advisors doing? And what was very interesting is that in the previous year, in 2008, only 9% of advisors said they were going to be buying small cap stocks in the next year. In this article we just looked at in 2009, that number jumped up to 27%. So right there, it's sort of, I found that really interesting because that is sort of one of the first signs that maybe the market might be moving back towards gaining confidence in stocks is if you're going into, a full third of advisors are looking to go into small cap stocks.
Which are quote unquote riskier.
Exactly. So to see that is sort of a small indication of some confidence returning to the market. Maybe something we can look for the next time.
The next cycle comes around.
Whenever that is.
All right, final headline from 2009 Arrow. Going to some individual stocks here, we have a couple. It says Citigroup shares fall below $1. And then the other headline is banks hold some gains, keeping sector green. Citigroup falling under $1 is pretty amazing. And if you look at the Citigroup stock chart today, you might say, I don't see it falling below $1. And we have to remember that there was the reverse stock split. I believe it was a 10 for 1.
Yeah, I think so, yeah.
$1 became $10. So if you're looking back at the performance, yes, it really did get below $1, which is pretty amazing.
I think that's, again, what we talk about when looking back at this stuff, these articles. A company like Citigroup falling below $1, it is extremely tough to sort of keep a long-term perspective on these things when there's such a sort of a big milestone for a huge company like that to fall below $1. That's frightening, and it's very difficult as an investor to sort of keep your mindset of focusing on the business and not the stock. I mean, it's tough.
The second one we had there was alluding to Goldman Sachs and their famous conviction buy list, conviction sell list, and they came out with a conviction sell on American Express and told their clients to buy Morgan Stanley. We have a chart here of the performance since then, and not to poke fun at Goldman too much, but American Express total return is up 740% since that time. Morgan Stanley up a measly 60% and lagging the market since that time. So we're not going to make fun of Goldman too much. Their clients have a different interest in mind, but just goes to show you that their recommendations aren't meant for everyone.
Exactly. And again, we are putting that starting point on that graph at the very bottom.
Right.
So, I mean, if you perfectly timed it, you'd have that, 756 or whatever percent it was. I think, like you said, the important thing to remember is that these forecasts, it's easy to use those as a shortcut with investment, but you got to remember what's their time frame. What are they looking at with this stock? Are they holding it for 5 to 10 years or indefinitely because they believe in the business? Or is it more that they're selling it because they don't like the outlook for the next year?
Probably closer to the next year.
Exactly. And I think that's the important thing as an individual investor is to know, do you believe in this business? Do you think American Express is a good business? Is it something where you should be concerned then about the stock price over the next year?
Very interesting.
Yeah.
Very, very interesting. Well, hopefully we don't have something like that come around next
Sure,
time, but it
sure,
will.
sure.
And we'll address it here. And then I'm sure people will look back and make fun of us.
Absolutely.
All right, moving on to the focus for today. One of the investors that you like to learn from, we always talk about Warren Buffett on here, Charlie Munger, guys like that. One of the guys that you focus on is Joel Greenblatt, who he's not as flashy as Buffett. He's kind of under the radar. He's written some books. But he uses something he calls the magic formula, which is basically a screen for companies that have high returns on capital, that are basically trading at a discount to kind of what they're actually worth. And he just very mechanically buys the ones that are undervalued, sells the ones that are overvalued. One of the caveats to his magic formula is you can't use it for financials.
Exactly.
And on this show, we talk almost exclusively about financial companies here. But something that you've been playing around with is, what if I wanted to create a magic formula for financials?
Yeah.
What would I look at? So what are some of the metrics and key themes that you've been looking at in this?
Sure. So I think one of the big things about the magic formula, why I think it's so powerful, is the fact that it sort of removes the emotional part of investing. You know, you're focusing, like you said, on return on capital for businesses. So are they just good businesses? Are they returning a lot of money for each dollar invested? And then their earnings yield. Are they trading at a discount? If you just take those two simple key metrics, you can sort of find those solid businesses that are trading at a discount, and like you said, just sort of methodically buying and selling those as they pop on the list and as they fall off the list. So with banks, with financial stocks, it's a little bit more difficult. Banks in particular, you can't obviously just look at sort of profitability and discount. We want to look at, are these solvent? Are these going to be safe banks to invest in all sorts of environments? And
because like we just said, there will be more cycles.
Exactly. And I think what's great about trying to figure out a magic formula for the banks is that we've sort of got the best stress test possible in the past 5 to 7 years.
A real stress test.
Exactly, a real stress test. You can actually see in the financials who overextended themselves leading up to the crisis and paid for it, and who are the other banks that were maybe less flashy, less sexy, that just kind of continued doing their basic, core business, that stayed within their circle of competence and survived and did well because of it. So with that, I sort of try to pick sort of 3 key things I want to look at when I'm analyzing a bank: profitability, financial health, and credit quality. So profitability, for instance, I've been looking at a metric, it's called pre-tax, pre-provision earnings, basically trying to sort of distill the bank's business, what money it's making before doing all sorts of adjustments.
All the credit stuff.
Exactly. I'd sort of compare it to sort of a free cash flow for normal businesses, trying to get to what money is or what cash is the business generating. So we've got profitability there. Connected to that then is financial health, equity to assets. I want to see equity as a proportion of assets, is that number staying pretty high, and is it staying fairly stable? Does it look like they have discipline in maintaining a high level of equity?
Right, which is important because you can make profitability look really good by taking on a lot of leverage, especially in the banking business where leverage is inherent. So you want to have the healthy level and, like you said, keep it consistent.
Exactly. And then finally, profitability, financial health, and the last one is credit quality. Are they actually originating things that are going to perform well?
Which is optimal.
Exactly. So I think a lot of times you see profitability go up, credit quality go down, and then financial health eventually suffers as a result. What we're trying to do here is take all 3 of those and just kind of find that steady balance between the 3, to kind of find these companies that are, these banks that have been doing solid business for a long time. And again, the most important thing here too is that we're looking at all 3 of these metrics over 10 to 15 years. Something where we can look at different interest rate environments, different economic climates, things like that, to kind of gauge what they're doing over those different cycles.
Right, because it's really easy to look good in a very short period of time when the credit cycle's on the upswing. Your credit quality is going to look really good, but looking back at 15 years, you can see, all right, how did they actually do in that time frame? And is this probably better for kind of a smaller vanilla bank, one that doesn't have an investment banking arm, a trading operation? Are you kind of looking at this as, all right, I just want to see a commercial bank that takes in deposits, makes loans, and is more of a traditional bank? Yeah,
so this is definitely something where we've got to be more of the vanilla, community banks. Definitely when I first did this screen, I was seeing banks I have never heard of, I would never encounter in my life. One's in southeastern Oklahoma, things like that, just really tiny banks, but they're quietly doing a really good job. And I think that's the important thing, is that their business is understandable as much as a bank's business can be. They're not getting into a lot of investment banking, a lot of that black box stuff where it's hard to analyze. It's hard to figure out, are they profitable because they're making sound investments, or are they just making riskier, taking on more risk, and might pay for it in the future.
All right, good stuff.
Yeah.
All right, moving on to the mailbag. Let's get to the mailbag.
All right.
If you have an email address, it's WTMI@fool.com. I love questions. Tyler loves questions.
I do.
Matt's in Costa Rica. We can still forward him the questions. He can get them. He'll read them on the beach. Our first question today is from Justin. He says, you have mentioned on a few podcasts that the government would like to wind down the operations of Fannie Mae and Freddie Mac. The wifey and I are looking to purchase a home soon. So this is near and dear to me in the moment. As such, I've been in contact with several lenders. One of them told me that all conventional loan products are sold to Fannie and Freddie. I couldn't find anything to corroborate this, only that standard conventional loans that conform to the federal requirements are able to be passed through to Fannie and Freddie. But the question remains, for me anyways, what happens to the lending process should Fannie and Freddie be shut down? Tyler.
Big question.
What's going on? Should Justin be concerned with his house buying process?
Sure. So I would just address the fact that the Fannie and Freddie shutting down, that's not really going to happen. There's no way to move that trillions of dollars of loans to another entity overnight. It's going to be a long process. It's been a long process, and I think it's still got a lot of ways to go. I think it's something where Mel Watt, the FHFA director, which is the organization that's basically overseeing Fannie and Freddie and sort of guiding this, one of the biggest financial reforms ever, he's been in the office in position for less than 100 days. So if you're thinking about getting a mortgage soon, you probably don't have too much to worry about. But I think one thing you might want to be worried about more than Fannie and Freddie shutting down is just interest rates. That's going to be something that's going to directly affect your borrowing costs. And it's something where, that is much more, we're able to see that a little bit more into the future than Fannie and Freddie reform. But to the borrower, anything going on in the secondary mortgage market right now is really not going to affect Justin that much. I think it's, like I said, just something where it boils down to the interest rate that you're paying.
And the first part of his question, when he says, in terms of Fannie and Freddie buying the conventional loans, it's kind of a nuanced answer. There's some, it's kind of a wonky answer, if you will. So yes, Fannie and Freddie do take on most conventional loan products. Most banks do not hold a 30-year mortgage that fits the federal requirements, as he says, they're on their books. Some do, but most give those to Fannie and Freddie for some sort of compensation, whether it's cash, securities that come back from Fannie and Freddie. But Fannie and Freddie take those securities, make mortgage-backed securities to keep the liquidity flowing into the process. So that's kind of the answer.
I think
I don't want to get too into the weeds.
Exactly. Let's just say basically I think almost all loans are conventional. A lot of them weren't in the past because they were going to private secondary mortgage market players. Pretty much all of those have, kind of gone kaput. So a majority of, almost all of the loans are going to probably be going to Fannie or Freddie. In some cases, the banks might decide to actually keep them on their portfolio, but that all depends on the lender itself. But it's a nuanced answer, and we don't need to get down in the nitty-gritty.
And the loans that'll be kept on the book, a lot of them will be quote-unquote jumbo loans, which don't fit the requirements there, that are bigger than what Fannie and Freddie can handle. So if you look at a Wells Fargo, they'll look at some jumbo loans from some of their higher net worth
California
clients
markets and things
and say,
like that,
okay, we're going to hold these on our books. That makes sense from a client relationship. So those are the type of loans that you usually see on the books at banks. All right, we have another mailbag question. Got a two for today. This one is from Jesse in Denver. He says, I listen to the show every day while doing the dishes. Can you each name 3 investing chores that you do in the upkeep of your investing portfolios? Give Jesse some chores. He doesn't have enough to do.
Sure. There we go. So my first chore, I would say, is keeping up and maintaining a buy and sell journal. So basically, the day I buy a stock, I want to make sure I have, sort of in one sentence, why I'm buying that. It doesn't need to be a full thesis or a full report or anything like that. It's just sort of so I know the reasoning why I was getting into this stock, because again, emotions can take over in terms of the price might dip of the stock 10% or more, something like that. I want to make sure I'm able to go back, look at my thesis, and say, has that changed?
Yeah.
If it has, if it no longer applies, then maybe it's time for me to get out of that stock. If not, then it helps me sort of say, okay, maybe it's time to dollar cost average or just sit put with this, but sort of keep my sanity, I guess, as the stock market goes wildly up and down.
Good point.
Yep.
Do you want to go back and forth?
Sure, why not?
All right, my first one is investigate the soft stuff.
Okay.
So we can get into the numbers, we talk about valuation, all that stuff, but sometimes I like to just go through the companies that I'm invested in and read about the management.
Sure.
What are they doing? What have they been saying in conference calls? What have they been saying at conferences? What's their past?
Yeah.
If it's a company that I know a little bit about the management, but when I bought the stock, I didn't fully do an entire research project on the management. I'll go in and try to learn something different about them. What are their experiences? Where could they possibly take this company? So that's one of mine.
I think that's a great one. I think it's also something where, too, there are things where you can just look at the company presentations over time. That's another way to kind of look at the soft stuff. See what they were talking about, 5 years ago. What were their exciting projects they were putting together?
And did they actually do them?
Did they actually do that, or are they just kind of quietly not talking about it anymore?
Yeah, exactly.
So it's a great one. So my second is, so it's sort of a chore. I would say it's always to have some sort of investment book on hand. Either investment or behavioral finance or just sort of a biography. I think those are all valuable things to have. And I try to basically do some sort of that reading every single day. I think that's important because it's one of the best ways to tune out that noise that you see in all the news every day. It's sort of, it can be very easy to get caught up in those things and very easy to sort of get really stressed out about what's going on in the markets.
Yeah.
So I think the best way to just sort of step back is to, read Ben Graham's security analysis from 1940.
Right.
He's talking about stuff that is entirely applicable to today.
Yep.
He was talking about post the Great Depression, but it's the same lessons that need to be applied today.
Right.
Something like that is great just to sit back, get away from the TV, get away from the Wall Street journals, all the tickers and everything, and all your portfolio movements, and just kind of tune out that noise and focus on the long term. Get some perspective there.
All right, my next one is try to learn something new, whether it be something important to the thesis or just something completely random about the company. Crack open the 10K or a recent presentation and just try to learn something new, whether it's a segment that is 2% of revenue, you still know it's there. It just gives you a fuller picture of what they're trying to do. So learn something new is something that you can just randomly do at any time.
And that's great because that's stuff that you don't give up after learning it. That only, Buffett's, one of his, nice little buzzwords is, compounding knowledge. By doing that, you might not find anything interesting, but you might also just gain some experience or some wisdom there that could help you in the future. And I think that's great to that's a great chore.
Final one. List. What do you got?
My final one is, I guess, a chore in some sense. It's not looking at my portfolio on a regular basis.
A chore of not doing something.
Exactly. I wish there were more of those. That's kind of nice. By not doing this, I don't want to be looking at my portfolio every single day. Especially, it seems like every time right after you buy a stock, it's going to go down for about a month or two. And I think that's important, kind of going with my second one, where it's just gaining that perspective and not letting yourself get caught up in the day-to-day vacillations of the market. I'm investing for the long term, so I need to make sure that I'm not gauging my progress or my performance on the short term.
Good point. All right. My final one, this is a harder one to get yourself to do. So I'll admit, it's hard for me to do this. But when we go out and try to find stocks to buy, we always do our analysis, we have our valuation, whether you modeled it out or whatever method you use. You do that when you buy it, right? Everyone should do that.
Sure.
But then going forward, you need to redo that on occasion and see if the valuation still makes sense going forward. So if you buy a stock with the expectation of, okay, I'm expecting based on my calculations, I'm hoping for 15% returns.
Yeah.
And then 2 years later, if you do it, and your assumptions have changed, the valuations changed, and it says, okay, going forward, this now only gives me 6% a year. That may not make sense to own that stock anymore.
Yeah, absolutely.
So to do revaluations of your portfolio and kind of say, does this valuation still make sense going forward? Because holding a stock is essentially the same thing as buying a stock going forward. So that's something that it's hard to do because you're in your head, you're kind of like, well, I already did the valuation. It's fine. It doesn't matter anymore.
You're committed to the stock now.
Exactly. But today's valuation is important as well.
I think that's really important. I think that's something I would want to improve on too, because it is something where, especially if you're projecting any sort of cash flows out in the future, you should probably be adding in the real data that you're getting as it goes along. So that's great.
All right, finishing off on the Twitter sphere, one tweet for today.
Okay.
Our one and only tweet. It is from Spencer Raskoff, the CEO of Zillow, friend of the Fool. He says, bought some Bitcoin this morning, buckle up. Tyler, why have you not converted your entire savings account to Bitcoin?
Oh man, I don't know.
Is it on the list of things to do?
I'm just too boring, I guess. I don't know. I just, like I said, I'm just doing too much reading, I think.
There you go. No cryptocurrency books?
No, I don't think any have come out. They're probably all ebooks at this point.
They are
I like the I like the physical books, so I'll wait till I can get it on Amazon. But
well, Matt and I still own on behalf. Well, the Fool owns on behalf of us 0.12 Bitcoin.
Okay.
Planning on holding it, I guess.
Excellent.
We did it for a project, but we're still holding on to it.
Excellent.
We'll see what happens.
Good to hear.
All right.
Good luck with that.
That is the show for today. You can find us on Twitter. We are at TMF Financials. You can also email us, WTMI@fool.com. We'll see you tomorrow.
All right.
People on the show may have interest in the stocks they talk about, and the Motley Fool may have formal recommendations for or against. Don't buy or sell stocks based solely on what you hear.